Welcome back. Our next guest is a market professional who has this message for investors: look beyond companies focused solely on the U.S. market. Let's bring in Mike Archibald, Vice President and Portfolio Manager at AGF Investments. He joins us from right here in Toronto. Mike, thanks a lot for joining us. I've looked at some of your notes, and you are constructive on stocks in 2025, but you think this will be a normal year. That sounds like you're calling for a positive year, but with perhaps much more modest returns than we've seen in 2023 and 2024. Why don't you elaborate?
Yeah, absolutely. Thanks very much for having me, Paul. It's great to be back on. So, I think certainly investors have gotten used to this idea of excessive returns. We've seen 20% moves in the S&P 500 in each of the last 4 years, 3 times to the upside, and then obviously in 2022 where we saw an almost minus 20% year to the downside. And so, history would suggest, in year 3 of a bull market, which is sort of where we are right now, returns tend to be a little bit more normal. So let's call it somewhere in that 4% range on average. We just don't see a lot more necessarily upside from the overall earnings multiple that you're willing to pay in the U.S. marketplace. So it's really going to be driven by earnings growth. And so, we still like the U.S. market. There's some high growth names that we find there, but we're sort of calling it a 2-speed recovery, if you will, or 2-speed playbook. And we're looking to other areas of the world, particularly in Asia and in Europe, where the playbook looks a lot like the U.S. 5 or 6 years ago. Fiscal spending is starting to pick up in those parts of the world. Obviously, with the German outcome, you may see a break to the debt cap ceiling that we saw there. And you're going to see more incremental spending, we think, on obviously on defense and infrastructure. So those parts of the world are going to see a modest uplift in growth, and we certainly think Trump is going to be restrained on fiscal spending in the U.S. And so still like the broader prospects for the U.S. in the medium term. We just think that this is probably going to be a year in which you see a bit of consolidation and incremental volatility like we've seen thus far so far in 2025.
What's your view on the Canadian stock market?
Yeah, that's going to be tricky. I mean, it really depends on what happens with tariffs. And so we see announcements again this afternoon that tariffs are coming into play. The expectation yesterday was that it was going to be in March, and now it seems like that's not going to be until April. Obviously, our view internally is that we are going to get some level of tariffs on some Canadian products. We don't think it's going to be at the 25% level. I think what you saw a couple of weeks ago when that was first introduced is obviously a lot of pressure on those companies that sell cross-border. And then you obviously saw some pressure on some of the financials, just given the concerns around possibility for a recession in Canada if we do get 25% tariffs. So we still remain constructive on Canada. We're going to need to see a little bit more of a playbook in terms of what the tariff outlook looks like. Our message to clients is to try to remain balanced. So have some defense in your portfolio, have some higher growth names in your portfolio so that you can kind of weather both sides of the storm.
Okay, you've got a couple of stock picks. They are U.S. stocks. The first one is CRH. It's a building and construction materials company.
Yeah, so they do work in the infrastructure space, housing, commercial development. So you can think things like cement, asphalt, aggregates. 75% of their business is in North America. That's split between government and private, and then the other 25% is rest of world, including Europe. We think that there's a couple of near-term catalysts here, as you have on the screen there. So the potential for a ceasefire in Russia and Ukraine, and we think that would be a big catalyst for this company. They have operations in Ukraine currently. That's not really in any of the numbers. Rebuild there is going to take a very long period of time, and they would be a benefactor of that. And then secondly, the company re-domiciled recently into the U.S., so they're headquartered there now. We see an opportunity potentially later this year or early 2026 for index inclusion. And I think that would increase, obviously, the investor demand and interest in the company. So good long-term grower. We expect to see sales and earnings grow somewhere in the neighborhood of 9 to 12% here in the next couple of years. Good compounding company and lots of catalysts here in the near term.
Okay, and another stock you like is Intuitive Surgical from the medical device sector in the United States.
Yeah, really like this company. It's been in the portfolio for a number of years. Really unique business, high growth, innovative company. So they are the global leader in robotic assisted surgery. They have greater than 80% market share. and a huge lead over competitors in the space. So more and more procedures these days are being done using robotic assistance, and that's to help with precision and better patient outcomes. There's only about 4% of overall procedures right now that are being done using robots, and we see a huge runway for continued growth for this company moving forward. They launched a new product in 2024 called the Da Vinci 5, and that continues to gain a lot of traction in hospitals in the U.S. and abroad. They get paid on new consoles and then as well on per procedure basis. So we expect procedure growth to be in the high teens for the next several years. EPS and sales growth, in the neighborhood of 15 to 20%. 2/3 of their revenue is in the U.S. and the other 1/3 comes from outside the U.S. So really like this business. We think it's got a long runway of growth here in a go-forward basis.
Mike, thanks a lot for joining us today. Mike Archibald is Vice President and